Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull, and I appreciate you being with us. Our show today is brought to you by the 2025 C5 plus CCIM Global Summit. Now, I've spoke at this event for the last 2-3 years at least. It's an incredible event. This year, it's in Chicago. It'll be September 16th through the 18th. You can find out more at C5Summit.real estate, and you want to do it. It's a great event. Well, today we're going to talk about the multifamily market. You know, people are always curious about apartments because there's so much talk about it in the world, right? Seems like almost every investment group has an interest in multifamily. Also, the talk about housing costs increasing all the time, and you know, there's a lot of solutions out there, and some of them just seem to be not taken. I don't know, but we've also seen a big increase in rents over the past many years. But then in the last few years, we've seen some of those rents flatten out a bit. Also on the investment sales activity, you know, obviously a lot of the property sectors, or most of them, dropped for the last couple of years because of the rapid increase in rates. Now activity is starting to pick back up. Well, let's really see what's happening with the market, with performance, and what to expect moving forward. Please welcome my guest. It's Carl Whitaker. Carl is Chief Economist with RealPage. Carl, good to see you.
Yeah, good to see you. It's been a minute. Hope you've been well.
Yes, I have. Thank you. And let's get right into it. You know, when you look at the performance of multifamily across the country, what are you generally seeing out there?
Yeah, it's been an interesting start to the year. I guess we're having this interview almost halfway through the year, and we're seeing that your underlying demand fundamentals for apartments remain strong. It may not seem like it on the operator side of the equation or the investor side of things, just because we haven't necessarily seen rent growth respond yet, at least in accordance to the level of demand that we're seeing. But that comes down to the fact that we're still in a once-in-a-lifetime wave of new supply. We'll talk about construction here in a little bit. Construction is easing. It's going to take a little bit of time before that shows up in a number of markets in terms of their realized deliveries. But as that supply wave starts to ease again, we'll see that demand should be continue to be strong enough to weather that wave of new units delivering. On the occupancy side, we're seeing that occupancy is approaching, or has recently, I should say, actually surpassed the 95% mark, which is kind of a magic number in multifamily. You know, that's effectively the point at which most groups would say you're functionally full, beyond just, you know, your typical frictional vacancy of people moving in and out, and the time to get units ready when those folks do leave. So I think overall the multifamily sector is in pretty good shape. It's just we're not necessarily seeing the rent growth nor the investment activity respond in the way that we may have expected based on just demand by itself.
Yeah. And of course, as our audience knows, rent growth and cap rates, all this is different for different communities and submarkets. But, you know, when you look overall, you mentioned rates. Are they a little flat overall, or are they increasing a little bit at this point? Or?
Yeah, I've somewhat jokingly said this, but there's some truth in it that if you look at a graph of rent growth the past couple years, you go back to 2021 into 2022, you know, it really looked like a ski slope where you had this big run up in rents. That run up, as we all know now, was just simply due to the fact that you had 2 years worth of demand squeezed into one calendar year, and the development activity that's now responding to those big rent growth years hadn't yet taken effect. You know, it takes a while for these new communities to come online from the time that they're permitted to develop. So you had this big run up in 21, 22, 23. So when you really started to see things level off. But since 24, we've seen kind of this, what I'm jokingly calling the bunny slope of rent growth, which is a little bit of growth returning on that graph, but still well below that long-term average. But I think the way that I've been phrasing this with groups out there is that if you look at just simple arithmetic, take monthly growth rates from 2025, take any 30-day window, and compare that to the same time of year in 2024, you're basically replacing the same number with the same number, i.e., you're seeing that rent growth is truly leveling off. We're not seeing a deceleration. And in fact, some months we're seeing a bigger number in 25 replace a bigger number in 24, which suggests that momentum is building. It's not a lot of momentum, but there is a little bit of momentum starting to build.
And overall, is it like 1 or 2%, or what is it?
So we're still seeing that rent growth is below 1%. As you mentioned, markets vary, but across the country, rent growth is about 0.7% as of May 2025. Long-term average, call it 2.5 to 3%. So we're still a long way off of that level. But at the same time last year, we were talking about 0.2, 0.3% for a number of markets. So again, there's a little bit of movement happening, but it's just not significant movement.
Yeah. And Carl, you mentioned new supply and the impact there. Has new supply or just deliveries has started dwindling yet, or are we still in the wave?
We're still in the wave, but if you look at a graph, we are technically ever so past that peak. And I mean, we're talking just, a rounding error when you look at where that graph actually is. But the nation, in terms of realized deliveries, if you look at a trailing 12-month period, technically peaked late last year. We're starting to see those numbers come down. I shared a little bit about this on LinkedIn earlier in the week, but we talked about how fast the drawdown in supply or realized deliveries is going to be. We talk about that construction number from earlier. The construction numbers slowed down so significantly in wake of those significant interest rate hikes. So the federal funds rate surging as high as it did, or as fast as it did, I should say. So really what we're seeing is we're kind of at this inflection point where supply is still really high on a trailing 12-month basis. But if you look at a more timely 60 to 90 day completion window, the quarterly numbers are showing a significant drawdown. So I think really the takeaway here is that by the end of this year, we're going to see that we are fully past that supply peak for 9 out of 10 markets across the country. Once we get into 2026, we're going to start talking about some seriously compressed delivery numbers that, in fact, a number of markets haven't seen in, up to a decade, if not longer.
Wow. Yeah. And with the demand in some of those markets are still really high demand, what would you expect for rates and performance around that time?
Yeah, so our forecast is calling for rent growth to soon return closer to longer term averages. It may not be at the end of this year, but I think by summer 2026, we'll see a number of markets getting closer to, call it the 2% threshold. And I'll focus more on the Southeast here. Just, this audience probably a little bit more focused on the Southeast at large. In the Southeast, we see really kind of that microcosm of a lot of demand, but more supply, keeping the rent growth compressed today. I think when you look at that story through 25 and going into 26, assuming that demand remains equal, which we don't have any reason to think that demand will slow down, but assuming that all else is equal, we now know the supply number is going to be coming down significantly. So I wouldn't be surprised if we start seeing some individual markets in the Southeast by the end of next year actually flirting with a 3% rent growth on an annualized basis. And then going in to the following year, 27 and 28, I wouldn't be surprised if some markets start getting into the 4 to 5% threshold, again, just based on how fast that supply drawdown is happening.
Yeah. Yeah, that makes sense because the rates went up so fast. It kind of curtailed a lot of new development, didn't it? And then you've had the price, the construction cost increases from the tariffs, right?
Yeah, it's that story of, and I'm glad you say that about the pace of the hikes on the federal funds rate, because it's really not necessarily that nominal level. It's a higher level than we've seen in the past couple of years, because we did see an environment where the federal funds rate was basically nothing, but it's how fast those rate hikes happened, and especially clouding that construction outlook beyond the tariffs that you mentioned is this idea of when do rate cuts can start to materialize, and when do those actually start to feed into the system and feed into the equation. I think the consensus at the beginning of 2025 was that we would see 2 quarter point cuts, but now that we're halfway through the year, we're starting to kind of see some of those may not materialize. So it's still a little bit early to tell what happens in the very back of the year, but the interest rate environment, really the downwards pressure that's put on construction financing in particular is the biggest headwind for developers.
Yeah. And Carl, are there some sample markets or areas that you might have over more supply than they do deliveries and impact rates more than others?
Yeah, I think when we talk about supply getting outpaced by absorption or demand outpacing supply, we can probably point to almost every market in the country seeing that in 2026. You'll have a few laggards. I think Austin, Texas, Charlotte, North Carolina, maybe Raleigh, North Carolina, some of the places that are seeing double-digit inventory growth. It may take a little bit longer for demand to catch back up there simply because it is such a big chunk of supply moving through in such a short wave. But, even some of the big Sunbelt stalwarts like Dallas and Houston, Atlanta, we're seeing that supply or construction, I should say, is falling fast enough that, barring some true shock on the demand side of the equation, I think we're looking at 2.5% to 3.5% rent growth in a number of those markets. Now, there are some smaller markets out there that are showing a little bit of a different trend. You have some places like Savannah that are going to have a little bit longer of a supply tail. Now, having said that, their demand tail may also be longer because we have kind of seen a reinvention of that market. You also have some of the smaller upstate South Carolina markets like Greenville and Spartanburg that are seeing supply come down to their lowest level, or I should say forecasted supply coming down to their lowest level in over a decade. So, there's going to be some nuanced stories when you start getting to that more localized level. But outside of a very, very few outside of a very few select markets, I should say, I think you're going to see demand comfortably outpace supply in most markets by 2026, certainly into 2027.
Yeah. Well, it'll be interesting to see how those rents get, in those markets like that, where the new supply is really dwindling. Carl, we're out with a $80 million Class A project right now. And I was looking at caps and, some of the non-Class A apartment commercial real estate people, I told them the caps are running 5%. And they're like, 5%? Wait, really? What do you see for caps out there and the trend there, Carl?
Yeah, we're seeing that cap rates are coming up a little bit. I think there's been a little of still a little bit of discovery period happening when it comes to the property sales. We talked a little bit about this earlier, that the sales activity just hasn't quite come back the way that a lot of folks expected. Certainly since the beginning of last year, whenever some prognosticators thought that we'd see some movement. Now, having said that, you are starting to see especially some movement in the Class A space, where some of the big REITs have really grown their presence, especially in the Southeast markets, where I think it was Equity Residential, if I remember right, just deployed a lot of capital and bought a portfolio in Atlanta. So we are seeing that there is certainly some appetite for that type of investment. But as we mentioned, the rates are kind of keeping some of that activity a little bit muted. I do think that as we go forward into 2026, we'll start to see NOI grow at a faster rate. That's obviously one of the components of the cap rate. The second component is I think we'll get a better idea and a better picture of what that long-term property valuation looks like. So that'll inform the other half of the cap rate equation. So there may be some markets where that doesn't line up with the overall national view, but I do think that we'll see cap rates continue to tick up here for the next couple of quarters until the market finds a more established long-term equilibrium.
Interesting. Where are some opportunities, Carl, that you believe for acquisitions or even as maybe new development?
Yeah, I think so. I'm glad you mentioned, Michael, too, the difference between acquisition and development, because I think that there's a different narrative there for a number of markets. Right now, it's kind of paradoxical with all the supply story that we've been talking about, but I think right now is actually a good time to develop in most markets, pending that there is some form of demand base there. Obviously, developing, not to pick on a single market, but developing in an Akron, Ohio, or a Youngstown, Ohio, that's going to be a little bit tougher of a sell just because you're not really developing to a demand need in that market. But you could have some acquisitions that make sense in those markets. Now, if I did look more holistically at some markets that I think are ripe for opportunity on the development side of the equation, we hear a lot about the Texas markets and the Florida markets are seeing slowing migration. But the thing is, their migration trends are starting to look kind of similar to what they did in the 2010s. They're just not looking like they did from 2020 to 2023, i.e., coming on the downslope of this big supply wave. I think that there's a number of Texas and Florida markets that could make sense to develop in. The Carolinas, I still think makes sense, especially if you're a developer with a long-term hold period. From an acquisitions perspective, one kind of half-baked thesis that I have right now, but from an acquisitions perspective, I think what might be a fun cut of data to look at is kind of using the last big economic upheaval, 2008, 2009, as a benchmark. One of the strategies that was successful throughout the 2010s was basically buying those by the end of, let's call it you're an acquisitions group in 2019, you're an investment group in 2019, buying a property that was 7 years old, that was built in 2012, actually made a lot of sense because you weren't competing with a lot of product that was of that same age group. Now, the reason I'm kind of extending this a little bit long, but where I'm heading with this is that for acquisitions, if you're looking at buying like a 2016 or 2017, 2018 vintage, here in a couple years, you're going to be seeing that property coming up for a potential value add that's going to be a few years separated from this big wave of inventory that we saw in 2022, 2023, and 2024. So I think that, again, depending on where your investment thesis lies, I think that there's some different opportunities there, but I actually think that Class B segment could be ripe for some opportunity as we get into the second half of this decade, largely in some of these big demand, high growth markets.
Yeah. And Carl, what might be some opportunities for operators today to improve their results?
Yeah, one of the biggest ones, and the REITs are always a wonderful source of knowledge on their earnings calls. But if you listen to the REITs and their earnings calls, one of the big things we hear is how important the lever of resident retention is for overall revenue growth. And I think resident retention is a great example of where you have both a quantitative benefit, i.e., you have a resident in that unit. You don't have to worry about that resident turning over. You don't have to worry about the marketing costs or how long that unit sits vacant, if it takes somebody to backfill that new vacancy. So you have the quantitative the quantitative benefit, but you also have the qualitative benefit, which just says residents that stay in place for longer. It kind of helps breed a better sense of community. That there's some tools there that operators can use to really incentivize resident retention, loyalty programs, and ways that they can really tailor to the needs of the resident. And I think you're seeing retention as a big lever that can be pulled to that. I think the other one to focus on, and this one's maybe a little bit of a longer term operator preference here, but really just listening to and understanding the needs of what is effectively a new generation coming into the demand pool, which is your Gen Z folks. I think your oldest Gen Z person is 27 or 28 years old. So, a lot of the marketing tools and a lot of the understanding of the resident needs over the past 10 years was tailored to that of the millennial cohort. Well, now you've got the Generation Z cohort coming into place, and there may not be drastically different needs between those two generations, but maybe enough that you could really listen to and maybe have some focus groups with those younger residents to see where the needs of the future are going to be.
Yeah. Well, they won't need to talk to the tenants, right? It'll all be digital, but
it'll all be AI driven, won't it?
Yeah. And it's like, yeah, they'll get AI communications back and forth and no actual discussion. So I'm teasing. Everybody's different, but things are changing. Carl, what would you leave our audience with to think about for the multifamily world moving forward?
Yeah, I think looking forward to the second half of this year, which again, it's just crazy to say we're already almost in the second half of 2025, but second half of this year, I think the one thing I would say is it's hard to separate noise from signal. Sometimes we see this in the economy. There's a lot of negative headlines. We see what consumer sentiment is doing, but that isn't necessarily translating to softness in the multifamily sector. Again, I shared on LinkedIn some thoughts on the economic noise earlier in the week, but I think the takeaway here is it's important to stay up to date and informed about economic trends, but do keep in mind that the economy and the rental housing market, those aren't necessarily a one-to-one relationship. Obviously, the economy can inform the multifamily sector, and it often does, but just be sure to dig a level deeper than what some of the headlines say, and try to pull out some nuance to come to your own conclusions. I guess don't lean too heavily on just one sensationalistic quote whenever there could be a little bit more devil in the details, if you will.
Yeah. Good point. Excellent point. Carl, good to see you. Thanks for being on the show.
Yeah, of course. Good to see you as always.
All right. And thank you for joining us around the country. Please let us know what you think. Hey, we appreciate you commenting. We appreciate you subscribing and also sharing the show. Please reach out to me if you have any thoughts for shows, or you have any questions, or you need a resource or a professional anywhere for anything related to commercial real estate. We'll try to point you in the right direction. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By the 2025 C5 Plus CCIM Global Summit, the premier commercial real estate conference for networking, deal-making, and investment. For more information, visit c5summit.realestate. For more podcasts and videos, subscribe and visit creshow.com.